The crypto industry is valued at more than $2 trillion, and it's the source of huge public interest as traders and prospective buyers try to understand the market and predict what comes next. But of all the crypto headlines you'll see each day, there is no topic covered more densely than the price of Bitcoin. Bitcoin goes up, Bitcoin goes down, and a myriad of explanations in between for why it's all happening, including interest rates, global security, or even a new president. But there is one angle consistently undercovered by mainstream press. Is it sexy? No. Does it matter? Yes. In fact, ironically, it might be the dynamic most likely to affect Bitcoin's price. We're talking about miners. Mining is the backbone of the Bitcoin blockchain, and its internal dynamics can have huge consequences for Bitcoin traders. Mining has two functions. It not only secures the network from attacks, but it also directly controls the supply of new Bitcoin. In simple terms, miners sit at the intersection of three key forces: network security, market supply, and investor confidence. It sounds simple, right? Secure the network, keep producing new coins, everyone's a winner. But hold your horses, because it's not that simple. Mining is ultimately a business, and businesses need to make a profit. That's where things get complicated. One of the most important and least understood forces in the Bitcoin market is the mismatch between miners' fluctuating Bitcoin income and their fixed expenses. Bitcoin block rewards make up around 99% of miners' income, so they live and die by that reward. In Bitcoin terms, block rewards are essentially static. They pay the same amount of Bitcoin for periods of around 4 years. For example, after the 2024 halving event, miners receive 3.125 Bitcoin per block. So, okay, the amount of Bitcoin stays the same, but the value in fiat of that Bitcoin doesn't. Just look at some of the insane price movements we've seen in the last 6 months. A Bitcoin now is worth around half as much as it was last summer. Still a Bitcoin. That matters because miners don't pay their bills in Bitcoin, they pay in fiat. Electricity, hardware financing, salaries, rent, maintenance, taxes, these are almost entirely paid in fiat currency, and they tend to be fixed from month to month. That's a problem when suddenly your Bitcoin income is worth half as much as it used to be. When miner income collapses, two things happen, and each one has an impact on the wider market. Number one, miners might sell their Bitcoin reserves. Bitcoin mining operations often hold enormous reserves of Bitcoin, and if they're in distress, they might sell some of it off to survive. That floods the market with new Bitcoin, bringing down its value even further. Thanks, Adam Smith. The second option is miner capitulation. This means mining operations that have been forced to shut down altogether. This also impacts the value of Bitcoin, but in a different way. As miners leave, the amount of hash power securing the network dwindles. This can raise concerns about Bitcoin security, causing another sell-off as holders worry about potential attacks on the network. Miner capitulation often signals the bottom in the market, but what's really interesting is what happens after that. The miners who have managed to remain in the network are the most robust, and that means that network security is more efficient than it was pre-purge. This can set the stage for later recovery, especially as Bitcoin sell-offs slow down. So to recap, miner economics turn Bitcoin price movements into real-world survival pressure for those miners. And that survival feeds back into the wider market. It shows up as price movements, or if you're watching very closely, even signals of what's still to come. So watch the miners, and you might be watching the earliest signals of Bitcoin's next move. Check out the full article where we get into the nuts and bolts of crypto mining on Wikipedia.